I think those are a lot of interesting insights on how you can construct the product to suit the investor. And there isn't a lot of data or even understanding from the investor side, or even, I guess, certain product manager side, in terms of how this style of investing can actually be optimized to serve many, many people. We have, I think, in this course of the conversation, talked about use cases, and I would like to come back to the question of suitability, right? Who does multi asset investing actually work for? And uh, if we can touch upon, say, family wealth, how does it help a family create wealth? How does it help in transitioning wealth across generations? And moving from, say, a real estate heavy portfolio into a financial product portfolio, what is the need today, right? I mean, we understand that liquidity, transferability, all of these are important questions that are there in families, but I don't think many people have really thought this through in terms of the next generation, especially when children move abroad. Like, what is the need to have these kind of things in place?
See, today, let's say you're having a land parcel somewhere in your suburbs or in a village, you have agricultural land, which is now becoming urban land. You have a house which is large, which you don't need, only two of you are there in the city, so you're not able to manage. You are pushed to a situation where you need to migrate out of real estate assets. In cities, just keeping your land vacant is very costly. Do you know that? You have to pay vacant land tax today.
I didn't know.
Nobody knows this.
Yeah.
Yeah. If I have a land parcel in the city and I'm not using it, there'll be a vacant land tax. So government wants you to use your land. So most people who have such assets don't have even the income to pay the tax. Please understand. Because the asset is a legacy. And then you have the fear of encroachment and all sorts of other, risks. So families which are not able to manage physical assets because of migration of next generation, because of aging of the people who are managing these assets, um, and because of unwieldy nature of assets. Sometimes the asset can become so big, around it all sorts of developments happen. And then when there are developments around the asset, the pressure starts
Correct.
coming.
Yeah.
Like if you have a nice plot with a frontage of 150 feet in the city, suddenly one blue box will come and somebody will try to set up a kiosk. Yeah, somebody will bring on pushcart and set up a hotel or whatever, tiffin
Yeah.
joint or whatever. So all this you can't manage if you're growing old. Then you have all sorts of problems. You put a caretaker, that fellow will claim ownership of part of the land, saying that I've been here for 20 years, I've got a voter ID card, this address. All sorts of headaches can happen. So people generally lose their appetite to own assets like this and manage it in this way. And there comes a time when they need to move out of real estate. Okay. So when you move out of real estate, let me tell you, you create so much liquidity. Like when I sold a parcel of real estate about 20 years ago, I got a large chunk of money. And I had been an equity investor already for 15 years. But still, I acknowledged first, I realized much before the money came in that I didn't have the choice of losing this capital into something. So, for a long time, I was thinking of how this capital can again be made into a long-term productive asset where it compounds for 15, 20 years. It took me 3 years to decide how I want to invest it. And I invested that money 7 years after I got the money. Just understand.
Wow.
2004-5, I got the money. 2007-8, after the crash, I had an idea of how I should invest that money after the global
Correct.
financial crisis. And I invested it in 2011-12. Understand this. It took me so much time because legacy wealth, even for a full-time equity investor, is a challenge. If I lost this money by investing it here and there randomly and mixing it with my portfolio approach without having a separate strategy for that, I could actually do disservice to that capital. Now you think of what people do today. I'll tell you the process, how legacy wealth works today. The money hits your bank account and from the next day your banker pesters you, right?
Yeah, we've heard so
Then
many.
you will have the private wealth guys running after you, right? You also want activity. So you want to be doing something with that money. You are in a hurry to do something. So all these combine together in a suboptimal way, sir. It doesn't combine well. This is my experience, right? And I always relate to how I did it and why I took so long. Then my learning from my own experience is that you should have a method which is comfortable for people to do it comfortably and to scale up the next thing without wasting the time that I did. I was lucky that I invested in 2011-12 and it became,
Hmm.
something which even I didn't expect it to. But everybody won't have that luck, and even I won't have that luck today again. I'm just telling you that if I'm going to relive that same experience today, I don't have that luxury, right? Because just that things came together like a positive conspiracy, right? But today you don't have that. So you need a approach where you think through what risk level you can take, how you're going to deploy capital, and how you're going to again make this proceeds from real estate very, very productive. And it will be also something which your next generation can monitor, measure, and enjoy, right? So all this has to be thought through. Whereas what happens once the money hits the bank account, banker pesters you, private wealth fellow comes, you have some random conversations, they give you some proposals, and then you start investing that money almost in one go, right? And 2 years later, you are in regret. You say that that person from this organization came, those guys talked a lot, but kuch nahi hua. They gave some product, we also bought. I asked my friend, I asked this person, that person. So it's like people do it randomly without a approach. Whereas you need a very, very solid approach. And that solid approach should bring investment rigor because it's multi-generation wealth that you're investing. It's not your monthly saving. It's something else. So for that, you need a certain approach. I feel that this multi-asset investing, the way we practice it, has got that rigor. I can actually give that person a strategy where he will not put all the money in one day if he's not comfortable. He'll be in debt for some time. Gradually, he'll keep investing. When the markets come down, he'll invest a little more. As his comfort level grows, he will keep adding. And we will basically achieve scale and he would have deployed the whole money over a period of time and after it's started working and it's harmonious. Just like you are comfortable owning a real estate wealth for 15, 20 years, you should be comfortable doing this also. Not
Correct.
2 years later say that, oh, that private wealth guy came, he said this, they gave this product, they showed the past performance, it's not performing. They gave me this PMS, which had done very well past 5 years, but last 5 years have been hopeless. So all those things should not happen, right? And most importantly, in the second sheet of your report, you know what's happened to your multi-generation wealth, to the last copper.
Correct.
You know what? You put what it is today, how much return is given over 1 year, 3 year, whatever, or 3 months, 6 months, 1 year, 3 year, whatever. I mean, whatever time frame. So you're able to see everything and you're able to benchmark it against something,
Yeah.
which is a hybrid index, right? So you have all these things. You can also compare it with Nifty. Absolutely zero problem. Actually, we do this exercise continuously where we compare with the Nifty, right?
Yeah.
To know because people compare, no? So we should also compare. And we also check out with the favorite equity products. Okay.
Yeah. I think I want to come back to one thing which you said, which is that when you have this legacy wealth that you need to pass on to future generations, you want something where you can measure, monitor, and enjoy. But we see parents come with all the right intentions. They think that they should buy this apartment for their son, this apartment for their daughter. They sort of spread these assets across with this perception that they are managing risk. They are giving them something useful, right? How useful is it for a child to inherit these kind of assets versus actually financial assets?
See, let's say you sell your land, you get the money, you want to buy a flat, right? And your son or daughter is going to use that flat potentially after 15 years. 15 years later, they come, they'll say that this flat is not what they would like to live in, because the concept of how an apartment should be changes every 5 years. What amenities, what kind of a community, right?
Correct.
Simple thing. You buy an apartment, 15 years later, the people living in it will be old people.
Yeah.
There will be no community. So your kids will say, who wants to live in that building? Right? The whole concept changes. Then what happens? They have to anyway sell it. When you go and sell it, you realize that they have made a return of 5%.
Yeah.
Because when you sell land, you get only value of the land. When you buy an apartment using that proceed, let's say you're buying it for the same amount, 40% is builder margin and overhead.
That's wild. Like if you think about the calculation,
Yeah.
then
So
how can you
you
expect
got
the return?
you sold 100 worth of real estate and you got 60 worth of real estate actually. And then after 10 years, you have to sell this 60 and hopefully get return on the 100, right? Because
Yeah.
the 40 you have to make up first. And then only you're going to profit. And then you have to buy another asset where you again give a 40, right? My logic is that you don't have to do this at all. You let it financially compound. Let your kids buy whatever asset they want when they want. See, people only look at the returns in asset, the escalation in valuations in isolation. Now, the way I will look at it is, I sold my land in 2004. Let's say I got realization in lakhs of rupees. I invested. 20 years later, that money is much higher. Today, I will take that money and say, if I went back to buy that land, how much more money do I have after buying that land?
Correct.
Right? People don't do this math. What people do as math is, they just calculate these appreciation in silos and they don't know what return they would have made in financial assets. That's the problem. That's why I'm saying that you should be able to measure perfectly. When you measure perfectly, then you know the relative merits of these ratios.
Correct.
Because of the imperfection in measurement, because you do it by scattering, like somebody said you spread the manure around, no money,
Yeah.
like you spread manure around. So you do like that, then you are not able to really measure what you got from it.
Yeah.
So you do all these hypothetical calculation. Oh, I bought this apartment for 1 lakh. Today it is 1 crore.
Yeah.
Something like that.
Yeah.
I made 100 times. Probably if you are in financial asset, you might have made 200 times. You won't calculate it. It's like, I bought an apartment for
Yeah.
20 lakhs. Today, after 25 years, I'm getting 80 lakhs.
Yeah.
What's the return?
4 times in 20 years is really not much.
That's all. I raised my case. And I bought this as a value buy. I didn't pay top dollar. I bought it at the bottom of the cycle. Please understand. So what happens when you go and buy a apartment paying top dollar today?
You lose wealth.
So the alternative is you put the money in a financial asset, keep measuring it carefully, know what is happening, and then whenever people want to buy an apartment for consumption, you just take money out of this and enjoy. The last word.
Yeah.
Right? So this measurement and other things, if you do correctly in a financial asset, the enjoyment will also be significant and you still have extra money left after buying this asset.
Correct.
My experience with selling one asset and buying the same asset is that between these two decisions, I have had 20 years of compounding. In that 20 years also, I prepared for 7 years. Actually, it's 13 years of compounding only.
Correct.
Please understand. And I'm still able to buy far more real estate using the proceeds. Even if you're going back to the same asset class, you should do it sensibly. That is my view.
Yes.
Yes, real estate will go up. But if you are doing a financial asset management well, you will actually create more money than
What real estate can do.
most people don't. So they think reinvesting in real estate is better than doing financial investing. I think that they should try some approach, at least explore. Without exploring, you're concluding. No, that is how people generally conclude.
Correct.
I have a problem with that. I'm saying that try this out. No, I'm pretty sure that if a person sells a real estate and puts the money in multi-asset, he'll be able to buy back the same real estate and still be left with more money after 2 decades. I'm pretty sure.
I think that's definitely possible.
You will get one market bottom in real estate.
Yeah.
Usually, that may not necessarily be a market bottom in multi-asset,
Correct.
right? So you can just do an asset allocation there and just switch back if you want. You can buy an asset which will be useful to your children or to yourself. See, this is not taught through in a 360-degree way. It is binary. Sell real estate, buy real estate again. Sell real estate,
Or put it in an FD. I
put
feel.
it in FD. Sell real estate, go and put it in private wealth in the best performing equity funds of last 5 years blindly in one day, right? I think that you need nuance. No, it's a lot of money, right? Then you need to have some nuanced approach, which is also simple to, I told you, measure, grow and enjoy. You need an approach. Real estate is something which gives you money once in 10, 20 years, not every year. But you need to compound your money that comes out of real estate over a period of time. And you need to be able to reinvest that in real estate if you wish to. There's nothing wrong in that. And if you don't see the need, you must be able to comfortably own the financial assets and only enjoy and still have no regrets. That's the last and most important thing. I think today when people move wealth from one asset class to another, mainly from real estate, they always land in a situation where they regret. One. And second, when they are doing it from one generation to another as a transfer of capital or assets, there is hardly any preparation. And those decisions which are made when assets change character or color lead to destruction of wealth. I am saying this quite openly. So these things need to be avoided. So I think somebody who is managing an intergenerational transfer must explore multi-asset because it will give them that comfort. I am very confident it will give them that comfort. And when they explore it, that comfort will grow on them. I am not asking them to put all their money in one day. You explore it, grow your comfort, and the comfort will grow on you. Measurement will be very good, and you will be able to also explain to your kids who are sitting somewhere else in 10 minutes what is happening. Because they don't have more time than that to ask questions of you or to even engage, because they are busy with their own lives. So these are all things which I feel help how we manage wealth across generations, between generations. And also these are approaches which I think have far more value than just generating returns. I am not even going into the return generation, but just the comfort, just the convenience and the clarity will be far superior than the current ways of managing such money, which you believe is sophisticated, but is actually below that shroud of sophistication. It's actually crude. It doesn't have levers which can actually support your requirement. I mean, somebody coming every year and telling you change this, do that, blah, 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 blah. I mean, it's
It
nice
doesn't.
to have somebody sit in front of you and talk this subject and invite you to 3, 4 conferences and do all those things. But the job is not well done, Sam. It's 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 raw. I'll put it that way.
Yeah. It doesn't work. No, you have to stick with something for some time before it
There is no approach.
works.
It's all multiple tactics. If you if you just adopt tactics from time to time, taking inputs from different people, because that person also keeps changing,
Yeah.
right? How can you create a holistic approach? You need to have a holistic approach.
Yeah, so you were talking about how we've already covered on the product side, but the entire discussion that we've been having more has been on how do we go from creating generational wealth to multi-generational wealth, right? And that's how we work. We are not looking at just creating a product and then giving it to people, say, yeah, this is just fitting you. There's that much level of sophistication that we work with someone one on one. So how do you think that when that statement that you said that you can do this for 50,000 people, how do you think that we can achieve that level of scale?
See, a process will support. You will not go and buy illiquid stocks. You will not try to do things which are not scalable. So, when you think of a product itself, when you take in an element into a product, you already evaluate whether that element is scalable. And you bring in the element only which is scalable. Because you can show some results at 500 crores, and when the moment you go to 2500 crores, you are lost. That should not happen. In this approach, if you see, if you go and see each lever, if I give you 10 times the capital on a daily basis than you are getting today, will you be able to deploy comfortably or not? Answer is a clear yes. Why is it a yes? Because you have thought about it when you create the product itself, that this should be sustainable with growth, right? So, the product ideation should be correct. So, you should not take shortcuts to show returns in a product and then realize that the product does not suit more people. So, when you curate a product itself, you should think of scalability. Those elements should be in the product. I mean, this is more from a product angle, but it's critical. It's very, very critical because that is what determines the experience of the investor. A product should serve the right experience to the investor during his period of ownership, any product. And it should have a clear target investor, not be a random product which just promises high return and goes after all kinds of investors. Now, if you see in this conversation, we have talked about so many user cases. Why? Because we have thought about it before the product is created.
And this is something we learned from the RIA practices when we were doing
This
it.
is what we learned from the 1,000 people whom we worked with, those experiences, okay. Whatever be those experiences, you have to turn it into something more positive, more growth oriented and with better delivery, right? So, you have an experience, you turn that experience into something even better, no? So, when you productize, in my opinion, you have an opportunity to create that better experience. That is what I really like about this whole thing. And when you are able to deliver that experience with scale, then you can actually discover that there are more user cases. Like my pain point was money coming out of real estate. I mean, I don't have a PF or a gratuity coming my way, which is significant. I didn't have that. Neither any of my family members had that. But asset monetization creates so much liquidity. Everybody has that, almost. All your relatives have that. They have to sell something and put it somewhere. So they don't sell because they don't know where to put it. And then they face other consequences. Squatting, encroachment, tenant troubles, tenancy problems, difficulty in realization of rent, all sorts of things come with assets. That was a user case which I have experienced. And I have seen this retiree who gets PF and gratuity, not doing a good job of it. I have hardly seen anyone do a good job of it. I mean, that is a tragic thing actually. So, to me, these two problems had to be solved. As we started solving these problems, we started realizing that people who sell ESOPs also make a mess of it. There is no approach. Somebody who sells a business, because we only think of selling an asset, but many people sell business because next generation is not coming in. They have a problem. In every situation, you are seeing that money which gets released from one asset, which is a lumpy asset, is always not being managed properly. Even today, you see people are discovering one or two products and saying that, oh, this is enough for me. I like those products. I have nothing against those products. But saying these one or two products are enough for me, like, like a mutual fund scheme. Two schemes I'll have. I don't think somebody with so much money should limit themselves. They will definitely benefit from nuance and sophistication, provided it's rightly delivered. So it's like you develop something and then you discover that there are more user cases. When we developed this, I told you, though, two user cases I told you, but now the number of user cases is increasing. The customer also comes and says, can I do this for this purpose? Like one person asked me, I am a doctor, I am saving money for my son and daughter to do medicine. I want only moderate risk. This money in 15 years should become enough for them to study medicine. And so he needs to compound at a certain rate, create capital, and then that money should go towards payment of undergraduate and postgraduate fees. Now, when we created Sphere as a multi-asset product or when we did RIA, we did not think that it will solve this specific problem. But it does, and the person is comfortable. So, user cases keep growing. So, that's the beauty of this. Because of its capability in risk management and the versatility of how you can package assets together, it's able to solve more user cases. And it's going to be very interesting because we haven't even touched the tip of the iceberg. Anybody who is in a bank's private wealth now and is not happy should just try Sphere multi-asset. Just try. Because there what happens? They buy some investments, it doesn't work, RM goes, new RM comes, new RM sells all the old investments saying that the old guy made a mistake, then he buys something else. You don't know actually how much money you put and what is the current value and what is your overall XARR. People don't even know this, Harshil. All these things will vanish when they come here. The measurement is very clear. No one can fool no one. First, the investor should not fool himself saying that he is doing well. Okay, all these private wealth guys and bankers also can't fool anyone. This is a pain point, right? Even recently you saw an asset management company which has entered private wealth give these as reasons. We have been doing this for last 15 years. We know this game actually. So, and we've seen it. I'm just saying it now because as I mentioned, it struck me that somebody is actually talking about it.
No, and to solve problems, you need to have first the understanding of the person who you're dealing with, and second the processes that you're setting itself.
That is very important. You need to know who you're dealing with, what they're going to do for you, how they are differentiated, how your interest is aligned, and how they are the right fit for you to travel the next 10 years or 20 years. You can't do that calculation based on just fees or something like that. It's much bigger. It's got to be much better. People are still discovering these things. I think the problem is we have a structure of managing wealth today which is very fee centric. I would want it to be more experience centric and measurement centric. Because if you measure correctly and you experience well, then you will have the answer whether the fee is right or wrong. I mean, you can't delude yourself. No one can delude you. That's a plain thing. How much you pay is incidental. But are you getting the right experience? Are you having honest measurement? If you have these two things, then fee is sorted. You will always find the answer, whether it's worth it or not.
No, managed solutions in India is quite cheap. In the US, everywhere else, right? In developed nations, it's definitely much more higher than India. Why?
See, this cheap, expensive,
Uh,
price is what you pay, value is what you get. If you're only going to obsess on price, okay, you will get only value to what you pay. You are not going to pay less and get more value, Harshil. It's unlikely. You only have to measure whether you're getting the value for what you pay. Whether the person has the integrity and capability to deliver value for what you're paying that person. And if you're getting, you should not bother. We are going and eating a breakfast for 800 rupees. Right? Are we actually eating for 800 rupees? Does anyone think about this? No, right? 90% of people who go and eat buffet lunches don't eat to the value they pay. That's not the case in financial products. You can measure. I gave this, fine, but this is what they have done for me. Am I comfortable? Am I happy with the experience of what I got? Have I got value? It's measurable, no. Tangible, no. The problem is that unlike in US where the managed solutions software is so resilient that you can get all the data, here the private wealth software, the bank always erases history, man. Understand that. It's not written in a way where it's transparent. If you remember when we did RIA, we will have an Excel in which you will put what all dates clients gave you money and then calculate weighted average
for each client, yes.
each client,
XIRR.
XIRR of Nifty versus whatever, and show them.
Where we had no software, nothing.
Nothing macro only. But the point is, today you don't need that, right? Because what you sold goes out of the window. If you make a mistake, that fellow will sell it and then it's gone. The loss is there in the books because your capital is eroded. But you don't measure it in your current portfolio. So what is not seen is forgotten. But that will not be the case in your product. When you productize, there's history, there's measurement. The second sheet tells you the story. Where are we? The fact that you made a winning bet or a losing bet and you're out of it is captured. So these are things which matter. These are things which matter. And I think that they matter more than what you pay. You don't realize. Have a different mindset towards the whole thing. You'll see what you're getting. You'll see the things in perspective. And anyway, from my perspective, I think that unless you deliver value, you don't deserve your pay. It's very simple. We have to work to deliver value. And you must be very clear in what value you can deliver. And try to deliver that value and something more. You can't promise returns, but you can set expectations correctly. And you must exceed those expectations without taking too much risk. As I said, modest risk, better returns. That is the positioning. Not jumping in a year of high returns and saying that, oh, I did so well this year, I bid this mutual fund, so you must give me all the money. No, we're not saying that. What we are saying is that here's a solution. These are the user cases. This will be the experience and this will be your enjoyment.
I think you perfectly summed that up as to what this whole conversation idea is about. So I think it's been a beautiful morning. It's the first start to the day.
Thanks. Now we are going to breakfast where we won't get value and let's have fun. Thank you.
Thank you so much for your time.